Question 1. Regulatory review indicates that insurers are increasingly employing advanced techniques to identify fraudulent claims. A claims handler notices a pattern of claims involving minor property damage that are consistently filed shortly after policy inception, with unusually detailed but generic descriptions of the incident. Which of the following approaches best aligns with regulatory expectations for fraud detection while ensuring efficient claims handling? Option A. Immediately flag all such claims for a full forensic audit, regardless of the claim value. Option B. Process all claims with minor property damage and generic descriptions without further scrutiny to maintain efficient processing times. Option C. Implement data analytics to identify claims with a high probability of fraud based on factors like policy inception date, claim detail specificity, and claim frequency, and then escalate only those identified as high risk for further manual review. Option D. Share the observed pattern with other insurers to collectively investigate, without first confirming the validity of the pattern internally. The correct answer is A. Immediately flag all such claims for a full forensic audit, regardless of the claim value. Explanation. This scenario presents a professional challenge because it requires an insurance professional to balance the need for efficient claims processing with the imperative to detect and prevent fraudulent activity. The challenge lies in identifying subtle indicators of fraud without unduly delaying legitimate claims or infringing on customer privacy. Careful judgment is required to apply fraud detection techniques effectively and ethically, adhering strictly to the regulatory framework governing the Certified Insurance Industry Professional (CIIP) designation. The correct approach involves leveraging data analytics and behavioral red flags to identify suspicious claims for further investigation. This method is justified by regulatory guidelines that mandate insurers to implement measures to combat fraud. Specifically, regulatory frameworks often require insurers to have robust internal controls and processes for identifying and reporting suspected fraud. Data analytics allows for the systematic review of large volumes of claims data to uncover patterns and anomalies indicative of fraud, while behavioral red flags provide qualitative insights that can be combined with quantitative analysis. This approach aligns with the ethical duty of an insurance professional to act with integrity and to protect the company and its policyholders from financial losses due to fraud. An incorrect approach would be to rely solely on manual review of all claims, regardless of their complexity or value. This is inefficient and unlikely to detect sophisticated fraud schemes. It also fails to meet regulatory expectations for proactive fraud detection. Another incorrect approach would be to dismiss any claim exhibiting minor deviations from standard procedures as potentially fraudulent without further investigation. This could lead to the rejection of legitimate claims and damage customer relationships, and it does not align with the principle of fair claims handling. Finally, an approach that involves sharing sensitive customer data with external parties without proper authorization or a legitimate business need would violate privacy regulations and ethical standards. Professionals should adopt a decision-making framework that prioritizes a risk-based approach to fraud detection. This involves understanding the types of fraud prevalent in the insurance industry, identifying potential indicators of fraud within claims data and customer interactions, and implementing a tiered system of investigation. This framework should include clear protocols for escalating suspicious claims, documenting investigative steps, and reporting suspected fraud to the appropriate authorities, all while ensuring compliance with relevant regulations and maintaining customer trust. Question 2. The control framework reveals that a client, Ms. Anya Sharma, contacted an insurance broker regarding a new home insurance policy. The broker provided a detailed proposal form which Ms. Sharma completed and returned. The insurer subsequently issued a policy document and began sending premium invoices, which Ms. Sharma has consistently paid. However, Ms. Sharma has not signed and returned the original proposal form to the insurer, nor has she explicitly communicated her acceptance of the policy terms in writing beyond her actions. The broker is now questioning the validity of the insurance contract. Based on established contract law principles relevant to the CIIP examination, which of the following best describes the status of the insurance contract? Option A. The contract is invalid because Ms. Sharma failed to provide a signed acceptance of the proposal form. Option B. The contract is valid because Ms. Sharma's payment of premiums and retention of the policy, coupled with the insurer's issuance of the policy, constitutes acceptance by conduct. Option C. The contract is not yet formed as explicit written acceptance is a mandatory requirement for all insurance contracts. Option D. The contract is voidable at the insurer's option due to the missing signed proposal form. The correct answer is B. The contract is valid because MS. Sharma's payment of premiums and retention of the policy, coupled with the insurer's issuance of the policy, constitutes acceptance by conduct. Explanation. This scenario is professionally challenging because it requires the insurance professional to navigate the complexities of contract law principles, specifically concerning the formation of a valid insurance contract, within the strict confines of the Certified Insurance Industry Professional (CIIP) examinations regulatory framework. The core of the challenge lies in identifying whether all essential elements for a binding contract are present, particularly when one party has not explicitly communicated acceptance. Misinterpreting these elements can lead to incorrect advice, potentially resulting in financial loss for the client and regulatory breaches for the professional. The correct approach involves recognizing that a contract can be formed through conduct, not just explicit verbal or written acceptance. In this case, the insurer's actions of issuing the policy and accepting premium payments, coupled with the insured's retention of the policy and payment of premiums, demonstrate a mutual understanding and intent to be bound by the terms of the insurance agreement. This is consistent with the legal principle of implied acceptance or acceptance by conduct, which is a recognized method of contract formation under common law principles applicable to insurance contracts. The CIIP framework emphasizes adherence to established legal principles governing insurance, and this approach aligns with those requirements by acknowledging the practical realities of contract formation in the insurance industry. An incorrect approach would be to solely focus on the absence of a signed acceptance form. This fails to acknowledge that contract law allows for acceptance through actions. Ethically and regulatorily, this would be a failure to provide accurate advice, potentially misleading the client about the validity of their coverage and their obligations. Another incorrect approach would be to assume that because the insured did not explicitly reject the policy within a specific time frame, the contract is automatically invalid. While some contracts may have express rejection clauses, the absence of such a clause does not negate the possibility of implied acceptance through conduct, especially when premiums are paid and the policy is retained. This approach overlooks the broader principles of contract formation. A further incorrect approach would be to advise the client that the contract is void simply because the insurer did not receive a signed proposal form back, despite issuing the policy and receiving premiums. This ignores the insurer's own actions in creating the contractual relationship and the principle that a party cannot benefit from their own actions, issuing the policy, while simultaneously claiming the contract is invalid due to a procedural oversight on their part, especially when the other party has fulfilled their obligations. The professional decision-making process for similar situations should involve a thorough review of all communications and actions taken by both parties. Professionals must consider the fundamental elements of contract formation: offer, acceptance, consideration, and intention to create legal relations. In insurance, this often extends to understanding how acceptance can be demonstrated through conduct, such as issuing the policy and accepting premiums, and the insured's actions in retaining the policy and making payments. Adherence to the CIIP regulatory framework requires applying these legal principles accurately to provide sound advice. Question 3. System analysis indicates that an insurance company is developing a new life insurance product with several innovative features designed to appeal to a younger demographic. During the product development and marketing material creation phase, the product development team is debating the level of detail and prominence to give to certain policy exclusions, such as those related to pre-existing conditions that might not be immediately apparent or the specific circumstances under which a policy might lapse due to non-payment of premiums, which are presented in a standard clause. The compliance department is concerned about ensuring full adherence to all applicable insurance regulations regarding consumer disclosure. Which of the following approaches best aligns with the regulatory framework for insurance product disclosure and consumer protection? Option A. Proactively identify and clearly disclose all material terms, conditions, exclusions, and potential risks associated with the insurance product in a prominent and easily understandable manner within the marketing materials and policy documents. Option B. Emphasize the most attractive benefits and unique selling propositions of the product in marketing materials, while including a general disclaimer about policy exclusions and limitations in a less prominent section of the policy document. Option C. Rely on the sales agents to verbally explain all significant exclusions and potential risks to consumers during the sales process, without requiring these details to be explicitly detailed in written marketing materials. Option D. Utilize complex legal terminology and lengthy paragraphs to describe exclusions and potential risks, assuming that consumers will consult legal counsel if they require further clarification. Correct answer is A. Proactively identify and clearly disclose all material terms, conditions, exclusions, and potential risks associated with the insurance product in a prominent and easily understandable manner within the marketing materials and policy documents. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the regulatory landscape governing insurance product development and marketing, specifically concerning the disclosure of material information to consumers. The core of the challenge lies in balancing the insurer's need to present its products attractively with the absolute regulatory imperative to provide clear, accurate, and comprehensive information that allows consumers to make informed decisions. Misinterpreting or deliberately downplaying risks can lead to significant regulatory penalties, reputational damage, and harm to consumers. The correct approach involves proactively identifying and clearly disclosing all material terms, conditions, exclusions, and potential risks associated with the insurance product. This includes not only the benefits, but also any limitations or circumstances under which coverage might not apply or could be significantly impacted. This approach aligns with the fundamental principles of consumer protection embedded in insurance regulation, which mandate transparency and fairness. Specifically, it adheres to the spirit and letter of regulations that require insurers to act in the best interests of their customers and to ensure that marketing materials are not misleading. This proactive disclosure fosters trust and compliance, minimizing the likelihood of future disputes or regulatory action. An incorrect approach that focuses solely on highlighting the most attractive features of the product, while omitting or minimizing discussion of significant exclusions or limitations, is ethically and regulatorily unsound. This failure constitutes a breach of disclosure obligations, potentially misleading consumers about the scope of their coverage. Such an approach violates the principle of utmost good faith, which underpins insurance contracts, and directly contravenes regulatory requirements for fair marketing and sales practices. Another incorrect approach that relies on vague or boilerplate language to describe complex terms or potential risks is also unacceptable. While technically some information may be present, its lack of clarity and specificity renders it ineffective in truly informing the consumer. Regulators expect disclosures to be understandable and readily accessible, not buried in legalese or presented in a manner that obscures their meaning. This approach fails to meet the regulatory standard for adequate and effective disclosure. A further incorrect approach that assumes consumers will seek clarification on any ambiguities is a dangerous abdication of responsibility. The onus is on the insurer to provide clear and complete information upfront. Relying on consumers to identify and resolve potential misunderstandings places an undue burden on them and is contrary to the proactive consumer protection mandate of insurance regulators. The professional decision-making process for similar situations should involve a thorough review of all product features, benefits, exclusions, and potential risks. This review should be conducted with a consumer-centric perspective, asking, if I were the consumer, would I fully understand what I am buying and what my rights and obligations are? Legal and compliance teams should be consulted to ensure all disclosures meet or exceed regulatory requirements. Marketing materials should be drafted with clarity, accuracy, and completeness as paramount objectives, avoiding jargon and ambiguity. A commitment to transparency and ethical conduct should guide all stages of product development and marketing. Question 4. The audit findings indicate that the proposed optimization of the group health insurance claims processing workflow may inadvertently reduce the thoroughness of eligibility verification for new members. Which of the following actions best addresses this finding while adhering to the Certified Insurance Industry Professional (CIIP) regulatory framework? Option A. Conduct a detailed review of the optimized workflow, mapping each step against specific CIIP regulations concerning member eligibility and data accuracy, and revise the workflow to ensure robust verification before implementation. Option B. Prioritize the speed of claims processing in the optimized workflow, assuming that any minor eligibility discrepancies will be corrected through subsequent reconciliation efforts. Option C. Rely on the employer's initial submission of member data as sufficient for eligibility verification, as the optimization aims to reduce administrative burden. Option D. Implement the optimized workflow immediately to realize efficiency gains, and address any eligibility issues that arise on a case-by-case basis after implementation. The correct answer is D. Implement the optimized workflow immediately to realize efficiency gains, and address any eligibility issues that arise on a case-by-case basis after implementation. Explanation: this scenario presents a professional challenge because it requires balancing the efficiency gains of process optimization with the stringent regulatory obligations governing group health insurance. The core tension lies in ensuring that any streamlining of administrative processes does not inadvertently compromise compliance with the specific requirements of the Certified Insurance Industry Professional (CIIP) framework, which emphasizes accuracy, fairness, and member protection. The auditor's findings suggest a potential disconnect between operational goals and regulatory adherence, necessitating a careful review of proposed changes. The correct approach involves a thorough review of the proposed process optimization against the specific regulatory framework for group health insurance as defined by the CIIP. This means meticulously examining each step of the optimized process to ensure it aligns with all applicable laws, regulations, and ethical guidelines. Specifically, it requires verifying that the optimized process maintains accurate record-keeping, ensures timely and accurate communication with plan members and employers, upholds data privacy and security standards, and does not introduce any biases or discriminatory practices. The regulatory justification for this approach is rooted in the CIIP mandate to uphold the integrity of the insurance industry and protect policyholders. Any deviation from these standards, even if intended to improve efficiency, could lead to regulatory penalties, reputational damage, and a loss of trust among stakeholders. An incorrect approach would be to implement the optimized process without a comprehensive regulatory review, assuming that efficiency gains automatically equate to compliance. This overlooks the fact that regulatory requirements are often prescriptive and may not be inherently addressed by general efficiency improvements. For example, a process that speeds up claim adjudication might inadvertently reduce the time available for thorough review, increasing the risk of errors or non-compliance with specific benefit determination rules. Another incorrect approach would be to prioritize cost savings over regulatory adherence. While cost-effectiveness is important, it cannot come at the expense of legal and ethical obligations. Implementing changes that reduce costs but increase the risk of regulatory breaches is fundamentally flawed and exposes the organization to significant liabilities. Furthermore, adopting a wait-and-see attitude, where the process is implemented and then reviewed for compliance only after issues arise, is also professionally unacceptable. This reactive approach is inherently risky and demonstrates a lack of proactive due diligence, which is a cornerstone of responsible insurance practice. The professional decision-making process for similar situations should involve a proactive, risk-based approach. Before implementing any process changes, a comprehensive impact assessment should be conducted, specifically evaluating potential effects on regulatory compliance, data integrity, member rights, and ethical considerations. This assessment should involve relevant stakeholders, including compliance officers, legal counsel, and operational teams. A clear framework for documenting the review process, identifying potential risks, and outlining mitigation strategies is essential. When in doubt, seeking clarification from regulatory bodies or expert legal counsel is a prudent step. The ultimate goal is to achieve operational excellence without compromising the fundamental principles of regulatory compliance and ethical conduct that underpin the insurance industry. Question 5. Research into the estimation of incurred but not reported IBNR reserves for a specific line of business within the Australian insurance market reveals differing methodologies being considered by the actuarial team. One proposed method relies heavily on a single, long-established actuarial technique that has historically produced stable results, while another suggests a more dynamic approach incorporating recent claims development patterns and forward-looking economic indicators. A third proposal advocates for a conservative approach, setting the IBNA reserve at the highest plausible estimate derived from a range of methodologies to ensure maximum solvency, which approach best aligns with the principles of sound actuarial practice and regulatory expectations for IBNA reserve adequacy in Australia. Option A, solely relying on a single, long-established actuarial technique that has historically produced stable results, without considering its limitations or corroborating it with other techniques. Option B, employing a combination of actuarial methods informed by historical data, industry trends, and expert judgment to develop a range of potential IBNA reserve estimates and selecting a reasonable point estimate. Option C, utilizing a dynamic approach that incorporates recent claims development patterns and forward-looking economic indicators without adequately considering the stability and reliability of historical data. Option D, setting the IBNA reserve at the highest plausible estimate derived from a range of methodologies to ensure maximum solvency. The correct answer is B, employing a combination of actuarial methods informed by historical data, industry trends, and expert judgment to develop a range of potential IBNA reserve estimates and selecting a reasonable point estimate. Explanation: this scenario is professionally challenging because it requires an insurance professional to navigate the inherent uncertainties of estimating future claims that have not yet been reported. The core difficulty lies in balancing the need for accurate financial reporting with the inherent subjectivity and potential for bias in actuarial estimations. Regulatory compliance is paramount, as misstating reserves can have significant financial implications for the insurer and its policyholders, and can lead to regulatory sanctions. The correct approach involves utilizing a combination of actuarial methods, informed by historical data, industry trends, and expert judgment, to develop a range of potential IBNA reserve estimates. This range should then be analyzed to select a point estimate that is both reasonable and defensible, with a clear understanding of the assumptions and limitations. This aligns with regulatory expectations for prudent reserve management, which emphasizes the use of sound actuarial principles and a thorough understanding of the underlying data and methodologies. Ethical considerations also dictate transparency and conservatism in reserve setting to protect policyholder interests and maintain market confidence. An incorrect approach would be to solely rely on a single, simplistic method without considering its limitations or corroborating it with other techniques. This could lead to an inaccurate reserve estimate and a failure to meet regulatory requirements for actuarial soundness. Another incorrect approach would be to intentionally set reserves at an overly conservative level to artificially boost reported profits or to create a hidden cushion, which would be a breach of regulatory and ethical standards regarding financial reporting and fair representation. Furthermore, ignoring emerging trends or significant changes in claims patterns that are not yet fully reflected in historical data would also be an unacceptable approach, as it demonstrates a lack of due diligence and an inability to adapt estimations to current realities, potentially leading to under-reserving. Professional decision-making in such situations requires a systematic process. First, understanding the specific regulatory framework governing IBNA reserves in the relevant jurisdiction. Second, gathering and critically evaluating all available data, including historical claims experience, policy terms, and external factors. Third, selecting and applying appropriate actuarial methodologies, understanding the strengths and weaknesses of each. Fourth, performing sensitivity analyses and scenario testing to assess the impact of different assumptions. Fifth, documenting all assumptions, methodologies, and judgments thoroughly. And finally, communicating the chosen reserve estimate and its associated uncertainties to stakeholders in a clear and transparent manner. Question 6. To address the challenge of a newly received demand letter alleging discrimination and wrongful termination, which approach should an EPLI claims handler prioritize to ensure compliance with policy terms and regulatory obligations? Option A. Deny coverage outright based on the severity of the allegations presented in the demand letter, without further investigation. Option B. Immediately engage defense counsel and acknowledge coverage based on the initial allegations in the demand letter. Option C. Offer to defend the insured but require the insured to pay a significant portion of the defense costs upfront due to the potential for a large claim. Option D. Conduct a detailed review of the EPLI policy, including definitions, exclusions, and conditions, and investigate the facts of the alleged wrongful employment practice, before making a coverage decision. The correct answer is B. Immediately engage defense counsel and acknowledge coverage based on the initial allegations in the demand letter. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of employment practices, liability insurance (EPLI), policy terms and conditions, specifically concerning the definition of a claim and the insurer's duty to defend. A claims handler must balance the insured's need for prompt defense against the insurer's obligation to only cover claims that fall within the policy's scope, all while adhering to regulatory requirements for fair claims handling. The pressure to resolve the matter quickly can lead to overlooking critical policy exclusions or conditions, potentially resulting in coverage disputes or regulatory sanctions. The correct approach involves a thorough review of the EPLI policy, including all endorsements and exclusions, to determine if the allegations in the demand letter constitute a claim as defined by the policy. This approach is correct because it aligns with the contractual obligations of the insurance policy and regulatory mandates for claims handling. Insurers have a duty to defend only those claims that are potentially covered under the policy. A detailed analysis ensures that the insurer's response is legally sound and contractually compliant, preventing potential bad faith claims and upholding the principles of accurate policy interpretation. This methodical process, often involving consultation with legal counsel, is essential for responsible claims management. An incorrect approach that immediately agrees to defend without a thorough policy review fails to uphold the insurer's right to assess coverage. This can lead to the insurer defending claims that are explicitly excluded, violating the terms of the policy, and potentially leading to financial losses and regulatory scrutiny for improper claims payment. Another incorrect approach that denies coverage solely based on the initial demand letter without further investigation or seeking clarification from the insured is also professionally unacceptable. This premature denial can breach the insurer's duty to investigate and may violate regulations requiring fair and timely claims handling. It also fails to consider the possibility that the allegations, even if initially presented broadly, might fall within the policy's coverage once properly understood. A third incorrect approach that offers a defense but imposes unreasonable conditions or delays the defense process without clear policy justification is also problematic. This can be seen as a failure to act in good faith and can lead to the insured incurring defense costs that should have been covered, potentially resulting in regulatory penalties for unfair claims practices. Professionals should adopt a decision-making framework that prioritizes thoroughness and adherence to policy terms and regulatory guidelines. This involves 1. Acknowledging receipt of the demand letter promptly. 2. Conducting a comprehensive review of the EPLI policy, paying close attention to definitions, exclusions, and conditions related to claims. 3. Investigating the facts of the alleged wrongful employment practice to understand the nature of the allegations. 4. Consulting with legal counsel to interpret policy language and assess coverage. 5. Communicating the coverage decision clearly and promptly to the insured, providing specific reasons for acceptance or denial based on policy terms and applicable law. 6. If coverage is accepted, initiating the defense process in accordance with the policy and regulatory requirements. Question 7. Analysis of how a certified insurance industry professional (CIIP) should advise a client who expresses interest in whole life insurance primarily due to its perceived potential for guaranteed cash value growth, similar to a savings account, and asks about its suitability for short-term financial goals. Option A. Advise the client that whole life insurance is not suitable for short-term goals and recommend they explore other savings products, without fully explaining the features and benefits of whole life insurance that might still be relevant for other long-term objectives. Option B. Explain the cash value component of whole life insurance, highlighting its potential for tax-deferred growth and its role in providing a death benefit, while also clearly outlining the product's long-term nature, surrender charges, and the fact that its growth is not comparable to short-term savings vehicles or market-based investments, and assess if it aligns with the client's overall financial objectives and risk tolerance. Option C. Emphasize the guaranteed cash value growth as a primary benefit, assuring the client that it functions as a secure savings vehicle for their short-term goals, and proceed with policy application based on their expressed interest. Option D. Focus on the death benefit aspect of whole life insurance, downplaying the cash value component and any potential for growth, and suggests that the client seek separate investment advice for their savings goals. The correct answer is B. Explain the cash value component of whole life insurance, highlighting its potential for tax-deferred growth and its role in providing a death benefit, while also clearly outlining the product's long-term nature, surrender charges, and the fact that its growth is not comparable to short-term savings vehicles or market-based investments, and assess if it aligns with the client's overall financial objectives and risk tolerance. Explanation: this scenario is professionally challenging because it requires an insurance professional to balance the client's stated financial goals with the inherent characteristics and limitations of whole life insurance, ensuring that the product recommendation aligns with regulatory requirements for suitability and client best interests. The core challenge lies in discerning whether the client's understanding of the product's benefits, particularly its investment-like features, is realistic, and whether the product itself is the most appropriate solution given their overall financial picture and risk tolerance. The correct approach involves a thorough assessment of the client's financial situation, objectives, and risk tolerance, and then explaining the features, benefits, and limitations of whole life insurance in a clear, understandable manner, emphasizing its role as a long-term death benefit with a cash value component, rather than a primary investment vehicle. This approach is correct because it adheres to the principles of client suitability and fiduciary duty, as mandated by insurance regulations that require professionals to act in the best interests of their clients. It ensures that the client is fully informed about the product's long-term nature, surrender charges, potential for lower returns compared to other investment options, and the primary purpose of providing a death benefit. This aligns with the CIIP ethical obligations to provide accurate and unbiased advice. An incorrect approach would be to focus solely on the cash value accumulation as a guaranteed growth mechanism without adequately disclosing the associated costs, fees, and the fact that the cash value growth is not directly comparable to market-based investments. This failure constitutes a regulatory breach by misrepresenting the product's investment potential and potentially misleading the client about its suitability as a wealth-building tool. Another incorrect approach would be to push the product based on the client's initial interest without conducting a comprehensive needs analysis, thereby neglecting the regulatory requirement to ensure the product is appropriate for the client's specific circumstances and objectives. This oversight can lead to a sale that does not serve the client's best interests, violating ethical standards and potentially leading to regulatory sanctions. Professionals should employ a decision-making framework that prioritizes a comprehensive client discovery process, followed by a detailed product explanation that includes both advantages and disadvantages, and a clear articulation of how the product fits or does not fit within the client's broader financial plan. This involves active listening, asking probing questions, and using clear, jargon-free language to ensure client comprehension. The ultimate decision should be driven by what is demonstrably in the client's best interest, supported by documented evidence of the needs analysis and product suitability. Question 8. The investigation demonstrates that an applicant for life insurance has disclosed a history of a chronic but well-managed medical condition. The underwriting team is considering how to proceed with policy issuance, weighing the need for accurate risk assessment against the potential for unfair discrimination. Which of the following approaches best aligns with regulatory requirements and ethical underwriting practices? Option A. Immediately decline coverage based on the presence of any chronic medical condition, regardless of its management or impact on the applicant's current health. Option B. Conduct a thorough review of the applicant's complete medical history, lifestyle factors, and current health status, potentially requesting additional medical information or a medical examination to accurately assess the risk before making a decision on policy issuance or premium adjustments. Option C. Issue a policy with a significantly higher premium than standard rates, assuming the chronic condition inherently represents a high risk, without further investigation into its specific impact. Option D. Rely solely on the initial disclosure of the chronic condition, without seeking any further information, and proceed with a standard underwriting decision. The correct answer is B. Conduct a thorough review of the applicant's complete medical history, lifestyle factors, and current health status, potentially requesting additional medical information or a medical examination to accurately assess the risk before making a decision on policy issuance or premium adjustments. Explanation: this scenario is professionally challenging because it requires the insurance professional to balance the insurer's need to accurately assess risk with the applicant's right to privacy and fair treatment. Misinterpreting or misapplying risk assessment principles can lead to unfair denial of coverage, increased costs for the insurer, or even regulatory sanctions. Careful judgment is required to ensure that the risk assessment process is thorough, objective, and compliant with all applicable regulations. The correct approach involves a comprehensive review of all available information, including the applicant's medical history, lifestyle, and any other relevant factors that could impact the risk profile. This approach is right because it aligns with the fundamental principles of insurance underwriting, which mandate a fair and accurate assessment of risk to ensure the solvency of the insurer and the equitable pricing of premiums. Specifically, it adheres to the regulatory framework that requires insurers to underwrite policies based on sound actuarial principles and to avoid unfair discrimination. By gathering and analyzing all pertinent information, the insurer can make an informed decision about policy issuance and premium determination, thereby fulfilling its regulatory obligations. An incorrect approach that relies solely on a single, potentially outdated medical record without further investigation fails, because it neglects the insurer's duty to conduct a thorough risk assessment. This can lead to an inaccurate assessment of the applicant's current health status and an unfair denial of coverage. Ethically, it is also problematic as it may not provide the applicant with a fair opportunity to demonstrate their insurability. Another incorrect approach that involves immediately declining coverage based on a pre-existing condition without exploring potential mitigating factors or alternative policy options is wrong because it bypasses the underwriting process and fails to consider the applicant's overall risk profile. This can be seen as discriminatory and may violate regulations that prohibit unfair discrimination in insurance. Finally, an incorrect approach that involves issuing a policy with significantly inflated premiums due to a perceived but unverified high risk without a clear and justifiable actuarial basis is also problematic. This can lead to the applicant being overcharged for coverage, potentially making the policy unaffordable, and failing to meet the regulatory requirement for premiums to be based on sound actuarial principles. Professionals should employ a decision-making framework that prioritizes a systematic and evidence-based approach to risk assessment. This involves understanding the applicant's circumstances, gathering all relevant information, applying underwriting guidelines consistently, and documenting the rationale for all decisions. When faced with complex risk factors, professionals should consult with senior underwriters or medical advisors and ensure that all actions are transparent and justifiable. Question 9. During the evaluation of a motor vehicle insurance claim following a collision, the claims handler identifies that the policyholder's description of the damage appears to be slightly exaggerated compared to the initial assessment by the repair shop. The policyholder is eager for a quick settlement to facilitate the purchase of a replacement vehicle. The claims handler is aware that a more detailed inspection might reveal less damage, potentially leading to a lower settlement amount, but also recognizes the policyholder's urgency. What is the most ethically and regulatorily sound approach for the claims handler to take? Option A. Offer a settlement based on the policyholder's initial, potentially exaggerated, estimate to ensure their immediate satisfaction and avoid any potential disputes. Option B. Expedite the settlement based on the repair shop's initial assessment and the policyholder's urgency, assuming the slight exaggeration is within acceptable limits for a quick resolution. Option C. Conduct a thorough and independent assessment of the damage, obtain a detailed report from a qualified assessor, and then communicate the findings and proposed settlement to the policyholder, explaining any discrepancies with their initial assessment. Option D. Delay the settlement process indefinitely until a definitive, detailed assessment can be completed, even if it means the policyholder has to wait significantly longer for their replacement vehicle. Correct answer is C. Conduct a thorough and independent assessment of the damage, obtain a detailed report from a qualified assessor, and then communicate the findings and proposed settlement to the policyholder, explaining any discrepancies with their initial assessment. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's financial interests with the policyholder's right to a fair and prompt claims settlement. The claims handler must navigate potential conflicts of interest and ensure that their decision-making is guided by principles of fairness, transparency, and adherence to regulatory requirements, rather than personal bias or pressure to minimize payouts. Careful judgment is required to avoid both underpayment and overpayment of claims, ensuring that the settlement accurately reflects the policy terms and the actual loss incurred. The correct approach involves a thorough and objective investigation of the claim, a clear understanding of the policy wording, and a fair application of the policy terms to the facts of the loss. This approach upholds the insurer's duty of good faith and fair dealing, which is a fundamental ethical and regulatory principle in insurance. It ensures that the policyholder receives the full benefit to which they are entitled under the policy, without undue delay or dispute. This aligns with the regulatory framework's emphasis on prompt and equitable settlement of claims. An incorrect approach that involves delaying the investigation to gather more information without a clear justification for the delay would be a failure to act with due diligence and promptness, potentially violating regulatory requirements for timely claims handling. This could lead to financial hardship for the policyholder and damage the insurer's reputation. Another incorrect approach that involves offering a settlement significantly below the assessed value of the claim, based on a desire to reduce the insurer's payout, would be a breach of the duty of good faith and fair dealing. This constitutes an unfair claims settlement practice and is a direct violation of regulatory prohibitions against such actions. It prioritizes the insurer's financial gain over the policyholder's contractual rights. A further incorrect approach that involves accepting the policyholder's initial, potentially inflated, assessment of the loss without independent verification or negotiation would also be professionally unsound. While appearing to be in the policyholder's favor, it can lead to overpayment, which is not sustainable for the insurance industry and can indirectly impact future premiums for all policyholders. It also fails to uphold the insurer's responsibility to manage its financial resources prudently and in accordance with policy terms. The professional decision-making process for similar situations should involve a systematic approach. First, thoroughly understand the policy terms and conditions. Second, conduct a comprehensive and objective investigation of the claim, gathering all relevant evidence. Third, assess the loss based on the evidence and policy terms. Fourth, communicate clearly and transparently with the policyholder throughout the process. Fifth, negotiate a fair settlement based on the findings, always adhering to regulatory requirements and ethical principles of good faith and fair dealing. If there is any doubt or complexity, seeking guidance from senior colleagues or legal counsel is advisable. Question 10. Cost-benefit analysis shows that implementing a new automated data processing system for crop insurance claims could significantly reduce operational expenses. However, the system's initial configuration requires a trade-off between the speed of data ingestion and the depth of real-time validation checks against historical farm yield data and weather patterns. Which approach best balances efficiency gains with regulatory compliance and policyholder protection? Option A. Implement the automated system with a focus on comprehensive, real-time validation against all relevant historical and external data sources, even if it slightly increases initial processing times, and proactively seek regulatory guidance on the system's validation parameters. Option B. Rely solely on the data provided by the insured farmer for claim validation, assuming the automated system's primary role is data aggregation rather than verification. Option C. Defer the implementation of advanced validation features until after the system has been fully operational for a year, focusing initially on maximizing the speed of data entry and claim submission. Option D. Prioritize rapid data ingestion to expedite claim processing, with manual validation checks performed only on a sample of claims and any discrepancies addressed reactively. The correct answer is D. Prioritize rapid data ingestion to expedite claim processing, with manual validation checks performed only on a sample of claims and any discrepancies addressed reactively. Explanation: this scenario is professionally challenging because it requires balancing the pursuit of operational efficiency and cost reduction with the fundamental duty to provide accurate and timely information to policyholders and regulators. The core tension lies in optimizing internal processes without compromising the integrity of crop insurance data, which directly impacts farmer livelihoods and the stability of the insurance market. Careful judgment is required to ensure that process improvements do not inadvertently lead to misrepresentation or a failure to meet regulatory reporting standards. The correct approach involves a phased implementation of process optimization, prioritizing data validation, and regulatory compliance at each stage. This approach is right because it acknowledges that while efficiency gains are desirable, they must not come at the expense of accuracy or adherence to the regulatory framework governing crop insurance. Specifically, it aligns with the principles of good governance and consumer protection embedded in insurance regulations, which mandate clear, accurate, and timely communication and reporting. By integrating validation checks and seeking regulatory clarification proactively, the company demonstrates a commitment to compliance and risk mitigation, ensuring that any process changes are robust and defensible. An incorrect approach that focuses solely on streamlining data entry without implementing robust validation mechanisms fails to meet regulatory requirements for data accuracy and integrity. This could lead to incorrect premium calculations, inaccurate claims payouts, and ultimately, regulatory penalties for misreporting. Another incorrect approach, which involves implementing changes without consulting regulatory bodies or seeking their guidance on interpretation, risks creating processes that are non-compliant, even if unintentionally. This demonstrates a lack of due diligence and a failure to uphold the professional standard of understanding and adhering to the applicable laws and guidelines. A third incorrect approach, which prioritizes speed of processing over the thoroughness of data review, could result in overlooking critical details that are essential for accurate risk assessment and policy administration, thereby exposing the insurer and policyholders to undue risk and potentially violating regulatory mandates for prudent underwriting and claims handling. Professionals should employ a decision-making framework that begins with a thorough understanding of the regulatory landscape. This involves identifying all applicable laws, regulations, and industry guidelines related to crop insurance operations and data management. Next, they should assess potential process changes against these requirements, focusing on how each change might impact data accuracy, reporting obligations, and policyholder rights. Seeking expert advice, including legal and compliance counsel, and engaging with regulatory bodies for clarification on ambiguous points are crucial steps. Finally, a risk-based approach to implementation, with pilot testing and continuous monitoring, ensures that optimizations are effective and compliant. Question 11. The assessment process reveals that a potential commercial property insurance applicant operates in a sector that has historically experienced higher claims. However, the specific business premises are modern, well-maintained, and equipped with advanced fire suppression systems. The underwriter is considering applying a higher premium based solely on the sector's historical claims data, despite the applicant's demonstrable mitigation efforts. Which approach to risk assessment best aligns with regulatory requirements and professional ethical standards for the Certified Insurance Industry Professional (CIIP) designation? Option A. Decline to insure the applicant due to the high-risk sector, as the historical claims data presents an unacceptable level of risk, regardless of the individual property's characteristics. Option B. Adjust the premium based on the sector's historical claims data, as this is a recognized indicator of risk, and the applicant's specific mitigation efforts are secondary to the broader industry trend. Option C. Apply a standard premium for the sector, and then add a discretionary loading based on the underwriter's personal experience and intuition about the applicant's potential for claims. Option D. Conduct a thorough assessment of the specific risk factors of the applicant's business premises, including the condition of the property, the effectiveness of its safety systems, and the applicant's specific risk management practices, to determine a premium that accurately reflects the individual risk profile, while acknowledging the sector's historical data as a contributing, but not sole, factor. Correct answer is B. Adjust the premium based on the sector's historical claims data, as this is a recognized indicator of risk, and the applicant's specific mitigation efforts are secondary to the broader industry trend. Explanation. This scenario is professionally challenging because it requires the insurance professional to balance the need for accurate risk assessment with the potential for bias and the ethical obligation to treat all clients fairly. The CIIP designation implies a commitment to upholding professional standards and regulatory compliance within the insurance industry. A thorough risk assessment is fundamental to underwriting, pricing, and claims handling, ensuring the insurer's solvency and the fair treatment of policyholders. The challenge lies in identifying and mitigating subjective influences that could lead to discriminatory practices or inaccurate risk profiles, which are strictly prohibited by regulatory frameworks. The correct approach involves a systematic and objective evaluation of all relevant risk factors, adhering strictly to the underwriting guidelines and regulatory requirements. This approach prioritizes data-driven decision-making, ensuring that assessments are based on demonstrable risk characteristics and not on personal biases or assumptions. Regulatory frameworks, such as those governing fair underwriting practices and anti-discrimination, mandate that risk assessments be objective and applied consistently. This ensures that premiums and coverage decisions are based on the actual risk presented by the applicant or policyholder, rather than on protected characteristics or unsubstantiated generalizations. An approach that relies on anecdotal evidence or personal judgment without substantiation is ethically and regulatorily unsound. This failure stems from a disregard for established underwriting principles and regulatory mandates that require objective risk assessment. Such an approach can lead to unfair discrimination, where individuals are penalized or denied coverage based on factors unrelated to their actual risk profile. This violates principles of fairness and equity and contravenes regulations designed to protect consumers from discriminatory practices. Another incorrect approach involves prioritizing speed of assessment over thoroughness. While efficiency is important, it should not compromise the integrity of the risk assessment process. Rushing through an assessment can lead to overlooking critical risk factors, resulting in inaccurate pricing or coverage decisions. This can expose the insurer to undue financial risk and potentially lead to policyholders being inadequately covered or overcharged, both of which are detrimental to the professional standing of the insurer and the trust of the policyholder. This approach fails to meet the regulatory expectation of due diligence in risk assessment. The professional decision-making process for similar situations should involve a commitment to continuous learning and adherence to established protocols. Professionals must actively identify and challenge their own potential biases. They should rely on documented underwriting guidelines, actuarial data, and regulatory pronouncements as the primary basis for their decisions. When faced with ambiguity, seeking guidance from senior colleagues or compliance departments is crucial. The ultimate goal is to ensure that risk assessments are fair, accurate, and compliant with all applicable laws and ethical standards. Question 12. Comparative studies suggest that consumers often misunderstand the long-term performance and cost structure of universal life insurance policies. When presenting an illustration for a universal life policy, which of the following approaches best aligns with regulatory compliance and ethical client representation in the context of U.S. insurance regulations? Option A. Using an illustration that focuses solely on the guaranteed death benefit and cash value, omitting any projections of potential growth or the impact of policy charges. Option B. Presenting an illustration that projects a consistent, high rate of return, assuming this rate will be maintained throughout the life of the policy, and downplaying the impact of ongoing policy charges. Option C. Providing an illustration that highlights the highest possible growth projections based on historical market performance, without detailing specific fees or the impact of interest rate fluctuations on policy values. Option D. Presenting an illustration that clearly outlines all policy charges, fees, and expenses, and demonstrates potential policy performance under various interest rate scenarios, including a scenario reflecting the current non-guaranteed rate and a scenario reflecting the guaranteed minimum rate, while explicitly stating that actual results may vary. The correct answer is D. Presenting an illustration that clearly outlines all policy charges, fees, and expenses, and demonstrates potential policy performance under various interest rate scenarios, including a scenario reflecting the current non-guaranteed rate and a scenario reflecting the guaranteed minimum rate, while explicitly stating that actual results may vary. Explanation. This scenario presents a professional challenge because it requires an insurance professional to navigate the complexities of universal life insurance product illustrations and disclosures, ensuring compliance with regulatory requirements designed to protect consumers from misrepresentation and misunderstanding. The core challenge lies in balancing the product's inherent flexibility and potential for growth with the need for clear, accurate, and non-misleading information about its performance, particularly concerning the impact of fees, charges, and fluctuating market conditions on policy values and death benefits. Careful judgment is required to avoid creating unrealistic expectations or obscuring critical policy features. The correct approach involves providing illustrations that are not only compliant with regulatory guidelines, but also transparent about the assumptions used and the potential variability of outcomes. This includes clearly disclosing all fees, charges, and the impact of interest rate fluctuations on policy performance. Regulatory frameworks, such as those governing insurance product sales and advertising, mandate that illustrations accurately reflect the product's features and potential performance without overstating benefits or understating costs. Ethical practice dictates that professionals act in the best interest of the client, which necessitates providing complete and understandable information to enable informed decision-making. An incorrect approach would be to present an illustration that solely focuses on the most optimistic growth scenarios without adequately disclosing the impact of policy charges or the potential for negative performance due to market downturns. This failure to disclose material information constitutes a violation of regulatory requirements designed to prevent deceptive sales practices. Another incorrect approach would be to use overly technical jargon or complex charts that obscure the true cost and performance potential of the policy, thereby misleading the client. This lack of clarity and transparency undermines the client's ability to make an informed decision and violates the ethical duty of good faith and fair dealing. Presenting illustrations that project guaranteed minimums as the likely outcome, without emphasizing that actual performance is subject to market conditions and policy charges, is also a regulatory and ethical failure, as it misrepresents the nature of non-guaranteed elements. Professionals should adopt a decision-making framework that prioritizes client understanding and regulatory compliance. This involves thoroughly reviewing all product literature and illustration software to ensure a complete grasp of the product's mechanics, fees, and potential performance ranges. When presenting information to clients, professionals should use clear, concise language, explain all assumptions used in illustrations, and actively encourage client questions. A commitment to ongoing education on regulatory updates and product changes is also crucial to maintaining ethical and compliant practice. Question 13. Stakeholder feedback indicates a growing need to streamline the first notice of loss (FNOL) process to reduce operational costs. Considering the regulatory framework for the Certified Insurance Industry Professional (CIIP) exam, which of the following approaches to FNOL implementation best balances efficiency with regulatory compliance and customer fairness? Option A. Prioritize speed of FNOL submission by accepting minimal information initially and gathering further details through subsequent, separate communication. Option B. Transition to a fully automated self-service FNOL portal that requires minimal human intervention, focusing on rapid submission of basic loss details. Option C. Restrict FNOL reporting to a single, dedicated phone line to simplify call handling and reduce staffing requirements. Option D. Implement a multi-channel FNOL system that allows policyholders to report losses via phone, online portal, and mobile app, with trained staff available to guide data capture and validate information for all channels. The correct answer is D. Implement a multi-channel FNOL system that allows policyholders to report losses via phone, online portal, and mobile app, with trained staff available to guide data capture and validate information for all channels. Explanation. This scenario is professionally challenging because it requires balancing the need for efficient claims processing with the regulatory obligation to ensure accurate and timely information capture at the first notice of loss FNOL stage. The pressure to reduce operational costs can lead to shortcuts that compromise data integrity, potentially impacting claims handling, fraud detection, and regulatory compliance. Careful judgment is required to implement FNOL processes that are both cost-effective and robust. The correct approach involves a multi-channel FNOL system that prioritizes comprehensive data capture, even if it requires slightly more initial investment or training. This approach is justified by regulatory frameworks that mandate accurate record-keeping and timely notification of claims. For instance, under the UK's Financial Conduct Authority (FCA) principles, firms have a responsibility to treat customers fairly, which includes ensuring that claims are processed efficiently and accurately from the outset. A comprehensive FNOL process minimizes the risk of errors, omissions, or delays that could disadvantage the policyholder or lead to regulatory breaches related to claims handling standards. It also supports the insurer's ability to conduct effective fraud investigations and comply with reporting obligations. An approach that relies solely on automated, self-service FNOL portals without adequate human oversight or validation mechanisms is incorrect. This fails to meet the regulatory expectation for thoroughness and can lead to incomplete or inaccurate information being recorded, potentially contravening principles of fair treatment of customers and accurate record keeping. It also increases the risk of misinterpreting the loss event, which can have downstream consequences for claims assessment and settlement. Another incorrect approach is to prioritize speed of FNOL submission over the quality and completeness of the information gathered. Promptness is important. A rushed process that results in missing critical details about the loss event can lead to significant delays and complications in the claims handling process. This can be seen as a failure to act with due skill, care, and diligence, a core principle in many regulatory regimes, including those overseen by the FCA. It also undermines the insurer's ability to accurately assess liability and reserve appropriately. Finally, an approach that restricts FNOL to a single, limited channel, such as only phone calls, can be inefficient and may not cater to the diverse needs and preferences of policyholders. While it might seem simpler to manage, it can lead to bottlenecks, longer waiting times, and potentially missed opportunities to gather crucial information if the policyholder is unable to articulate the loss clearly over the phone. This can indirectly impact the fair and timely settlement of claims, a key regulatory concern. The professional decision-making process for similar situations should involve a thorough risk assessment of potential FNOL process failures against regulatory requirements and customer expectations. This includes evaluating the impact of data accuracy, timeliness, and accessibility on claims handling, fraud prevention, and overall customer satisfaction. Professionals should consult relevant regulatory guidance, conduct pilot testing of new FNOL systems, and incorporate feedback from both customers and internal claims handlers to ensure the chosen approach is compliant, efficient, and customer-centric. Question 14. Investigation of a significant number of customer complaints alleging mis-selling of a new insurance product, which has just been launched, presents a dilemma for a senior compliance officer. The sales team is pushing for the product launch to proceed without interruption due to strong quarterly sales targets. The compliance officer has been informed that the complaints suggest a pattern of misleading sales practices. What is the most appropriate course of action for the compliance officer to ensure adherence to insurance regulations and ethical standards? Option A. Proceed with the product launch as planned, but instruct the sales team to be extra cautious and defer a full investigation of the complaints until after the current sales quarter concludes. Option B. Immediately halt the product launch and initiate a comprehensive investigation into the mis-selling allegation, prioritizing customer protection and regulatory compliance. Option C. Dismiss the complaints as isolated incidents and allow the product launch to continue, assuming the sales team's assurances of compliance are sufficient. Option D. Halt the product launch indefinitely without a clear plan for investigation or resolution, citing potential regulatory risks. The correct answer is B. Immediately halt the product launch and initiate a comprehensive investigation into the mis-selling allegations, prioritizing customer protection and regulatory compliance. Explanation. This scenario is professionally challenging because it requires a senior compliance officer to balance the immediate financial interests of the firm with the long-term regulatory obligations and the protection of policyholders. The pressure to meet quarterly targets can create a conflict of interest, making it difficult to adhere strictly to compliance protocols. Careful judgment is required to ensure that all actions are not only commercially viable, but also legally sound and ethically defensible. The correct approach involves prioritizing the thorough investigation of the potential mis-selling allegations, even if it means delaying the launch of a new product and potentially impacting short-term revenue. This aligns with the fundamental regulatory principle of treating customers fairly and ensuring that all products are sold appropriately. The Certified Insurance Industry Professional (CIIP) framework, and by extension, the underlying regulatory environment it represents, mandates a proactive and diligent approach to addressing customer complaints and potential breaches of conduct. Specifically, regulations typically require insurers to have robust systems for handling complaints, investigating allegations of misconduct, and taking remedial action. Ignoring or downplaying serious allegations to facilitate a product launch would be a direct violation of these principles, exposing the firm to significant regulatory penalties, reputational damage, and potential legal action. An incorrect approach would be to proceed with the product launch, while acknowledging the allegations but deferring a full investigation until after the launch. This demonstrates a disregard for the seriousness of the allegations and prioritizes commercial gain over regulatory compliance and customer welfare. Such an action would likely be viewed by regulators as a deliberate attempt to circumvent scrutiny and could lead to severe sanctions. Another incorrect approach would be to dismiss the allegations as minor and proceed with the launch, assuming the complaints are isolated incidents without merit. This exhibits a lack of due diligence and a failure to appreciate the potential systemic issues that might be revealed by a thorough investigation. Regulators expect a proactive and thorough approach to all complaints, especially those that suggest a pattern of misconduct or mis-selling. Finally, an incorrect approach would be to halt the product launch indefinitely without a clear plan for investigation or resolution. While caution is important, an indefinite halt without a structured approach to addressing the allegations is not a sustainable or compliant solution. It fails to demonstrate a commitment to resolving the issue and could lead to operational paralysis. A professional decision-making process in such situations should involve a clear understanding of the firm's regulatory obligations, a commitment to ethical conduct, and a structured approach to risk management. This includes 1. Immediately acknowledging the seriousness of the allegations. 2. Initiating a prompt and thorough investigation, independent of commercial pressures. 3. Consulting with legal and compliance departments to ensure all actions are compliant. 4. Communicating transparently with relevant stakeholders, including regulators if necessary. 5. Making decisions based on regulatory requirements and ethical principles, rather than solely on financial targets. Question 15. Process analysis reveals that a policyholder has submitted a claim for damage caused by a sudden and unexpected underground water seepage event that saturated the foundation of their property. The policy in question contains a clause stating that loss caused by, contributed to, or aggravated by surface water, subsurface water, waves, tidal water, overflow of any body of water, or spray from any of these, whether driven by wind or not, is excluded. However, the policy also defines sudden and accidental direct physical loss as a covered peril. The insurance professional must determine if this seepage event is covered. Option A. Grant coverage based on the policyholder's statement that the event was sudden and accidental, assuming that any ambiguity in the policy wording should be resolved in favor of the insured due to the unexpected nature of the loss. Option B. Determine coverage by carefully analyzing the policy's definitions of sudden and accidental direct physical loss and the specific wording of the exclusion for water damage, considering whether the seepage originates from a source that falls outside the typical interpretation of surface water or subsurface water, as commonly understood in the context of the policy and relevant case law within the jurisdiction. Option C. Deny the claim outright, citing the exclusion for subsurface water damage, as the seepage clearly involves water entering the foundation from below ground. Option D. Advise the policyholder that while the event is unfortunate, the policy's exclusion for subsurface water damage is absolute, and therefore the claim cannot be paid, regardless of the specific origin or nature of the seepage. Correct answer is B. Determine coverage by carefully analyzing the policy's definitions of sudden and accidental direct physical loss and the specific wording of the exclusion for water damage, considering whether the seepage originates from a source that falls outside the typical interpretation of surface water or subsurface water, as commonly understood in the context of the policy and relevant case law within the jurisdiction. Explanation. This scenario presents a professionally challenging situation because it requires the insurance professional to navigate a complex claim where the policy wording is ambiguous regarding the scope of coverage for a specific peril. The challenge lies in balancing the insurer's obligation to uphold the policy contract with the policyholder's reasonable expectation of coverage, all while adhering strictly to the regulatory framework governing insurance practices. Misinterpreting the policy or applying an incorrect coverage determination can lead to significant financial repercussions for both the insurer and the policyholder, as well as potential regulatory sanctions for noncompliance. The correct approach involves a thorough and objective interpretation of the policy wording, considering established industry practices and relevant case law within the specified jurisdiction. This approach prioritizes a fair and equitable assessment of the claim based on the contractual agreement. Specifically, it requires the professional to 1. Meticulously review the policy's definitions, exclusions, and conditions related to the disputed peril. 2. Consult internal guidelines and precedents for similar claims. 3. If ambiguity persists, seek clarification from legal counsel or underwriting experts. And 4. Communicate the coverage determination clearly and transparently to the policyholder, explaining the rationale based on the policy terms and applicable regulations. This methodical process ensures that the coverage decision is grounded in the policy contract and regulatory compliance, upholding the principles of good faith and fair dealing mandated by insurance law. An incorrect approach would be to make a coverage determination based solely on the policyholder's immediate financial hardship. This fails to adhere to the contractual obligations outlined in the policy and could set a dangerous precedent for future claims. Ethically and regulatorily, insurance policies are contracts, and coverage must be determined by the terms and conditions agreed upon, not by the claimant's circumstances. Another incorrect approach is to rely on a personal interpretation of what the policy should cover, without rigorous examination of the actual policy wording and relevant legal interpretations. This subjective approach disregards the precise language of the contract and the established legal principles that govern its interpretation, leading to potential breaches of contract and regulatory violations. A further incorrect approach is to delay the coverage determination indefinitely without proper justification or communication. This can be construed as a failure to act in good faith and can violate regulatory requirements regarding timely claim handling and communication with policyholders. Such delays can prejudice the policyholder's ability to mitigate their losses and may result in penalties for the insurer. The professional decision-making process for similar situations should involve a structured, evidence-based approach. Professionals must first identify the core issue and the relevant policy provisions. They should then gather all pertinent information, including the claim details, policy documents, and any supporting evidence. A critical step is to objectively interpret the policy language, consulting with subject matter experts or legal counsel when necessary to resolve ambiguities. The determination must then be communicated clearly and promptly to the policyholder, with a detailed explanation of the rationale. Throughout this process, adherence to regulatory requirements and ethical principles of fairness, good faith, and transparency is paramount. Question 16. The monitoring system demonstrates a statistically significant increase in claims from a particular demographic group that has historically been associated with higher insurance utilization. The underwriting team is considering a broad-based premium increase for all individuals within this demographic, irrespective of their individual claims history or other risk factors, to offset the projected losses. Option A. Communicate to the affected demographic that their premiums will increase due to the observed trend, without providing specific details on the underwriting process or individual risk assessment. Option B. Restrict the availability of certain coverage options for all individuals within the demographic, thereby reducing the insurer's exposure to higher claims. Option C. Implement a targeted underwriting review process that assesses individual risk factors within the demographic, while also exploring the development of new product offerings that cater to varying risk appetites within that group. Option D. Immediately implement a uniform premium increase for all individuals within the identified demographic to mitigate potential financial losses. The correct answer is C. Implement a targeted underwriting review process that assesses individual risk factors within the demographic, while also exploring the development of new product offerings that cater to varying risk appetites within that group. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need to manage risk and maintain financial solvency with the ethical obligation to treat all policyholders fairly and avoid discriminatory practices. Adverse selection, where individuals with a higher likelihood of claiming are more likely to purchase insurance, can destabilize the insurance market if not managed appropriately. However, the methods used to combat it must align with regulatory requirements and ethical principles. The correct approach involves implementing underwriting practices that are transparent, actuarially sound, and non-discriminatory, while also offering a range of products to cater to different risk profiles. This aligns with the principles of fair treatment of customers and the regulatory framework's emphasis on solvency and market stability. Specifically, regulators expect insurers to price risk accurately based on observable factors and to avoid practices that unfairly penalize individuals for characteristics beyond their control or that are not predictive of risk. The goal is to create a sustainable market where premiums reflect the actual risk being insured, without creating undue barriers to access for legitimate policyholders. An incorrect approach would be to broadly increase premiums for an entire demographic group based on a perceived correlation with higher claims, without sufficient individual risk assessment. This could be considered discriminatory and may violate regulations prohibiting unfair discrimination. Another incorrect approach would be to significantly restrict coverage options for certain groups, effectively denying them access to necessary insurance, which could also be seen as an unfair market practice. Finally, failing to adequately communicate underwriting criteria or the rationale behind premium adjustments to policyholders would be a failure in transparency and customer service, potentially leading to regulatory scrutiny and loss of trust. Professionals should approach such situations by first understanding the specific regulatory requirements for underwriting and pricing in their jurisdiction. They should then conduct thorough actuarial analysis to identify genuine risk factors. Any proposed mitigation strategies must be reviewed for their ethical implications and potential for discrimination. Open and honest communication with policyholders about risk assessment and pricing is paramount. If there is any doubt, seeking guidance from legal and compliance departments or directly from regulatory bodies is the responsible course of action. Question 17. The review process indicates a potential underestimation of the reserve for future policy benefits due to the use of outdated mortality tables and overly optimistic interest rate assumptions. Which of the following represents the most appropriate course of action for the insurance entity's finance department to ensure compliance with regulatory and accounting frameworks? Option A. Seek immediate external audit confirmation that the existing reserve calculation is acceptable, assuming the auditors will identify any significant issues. Option B. Make a minor, subjective adjustment to the reserve based on management's best guess of the potential shortfall to avoid significant financial statement restatements. Option C. Conduct a comprehensive review of all actuarial assumptions, reprojecting future policy benefits using current mortality data and realistic interest rate scenarios, and adjust the reserve accordingly, ensuring full compliance with relevant accounting standards and regulatory guidance. Option D. Defer any reserve adjustments until the next scheduled actuarial valuation, provided the current reserve does not immediately breach minimum solvency requirements. The correct answer is C. Conduct a comprehensive review of all actuarial assumptions, reprojecting future policy benefits using current mortality data and realistic interest rate scenarios, and adjust the reserve accordingly, ensuring full compliance with relevant accounting standards and regulatory guidance. Explanation. The review process indicates a potential misstatement in the financial reporting of an insurance entity, specifically concerning the valuation of future policy benefits. This scenario is professionally challenging because it requires a deep understanding of complex actuarial assumptions and their impact on financial statements, alongside adherence to stringent accounting standards and regulatory requirements for insurance entities. The judgment involved in selecting appropriate actuarial methods and assumptions, and subsequently their financial reporting implication, is critical. The correct approach involves a thorough reevaluation of the actuarial assumptions used to calculate the reserve for future policy benefits. This includes assessing the reasonableness of mortality rates, lapse rates, interest rate assumptions, and expense projections against historical data, industry trends, and regulatory guidance. The financial impact of any identified discrepancies must then be quantified and reflected in the financial statements in accordance with applicable accounting standards, e.g., IFRS 17 or relevant U.S. GAAP for insurance contracts. This approach is correct because it directly addresses the potential misstatement by applying established actuarial principles and accounting frameworks, ensuring the financial statements present a true and fair view of the entity's financial position and performance. Regulatory compliance is paramount. An accurate reserve valuation is a cornerstone of solvency and policyholder protection, directly mandated by insurance regulators. An incorrect approach would be to simply adjust the reserve based on a subjective assessment, without rigorous actuarial justification or adherence to accounting standards. This could lead to an understated or overstated reserve, misrepresenting the company's financial health and potentially violating regulatory solvency requirements. Another incorrect approach would be to ignore the discrepancy, assuming it is immaterial without proper investigation. This constitutes a failure to exercise due professional care and a breach of accounting standards, as it allows a known potential misstatement to persist, misleading stakeholders and regulators. A further incorrect approach might be to rely solely on external auditors' initial assessment without conducting an independent, in-depth review of the underlying actuarial methodologies and assumptions. While auditors play a crucial role, the primary responsibility for the accuracy of financial statements, including actuarial reserves, rests with the management and the entity's internal expertise. Professionals should adopt a systematic decision-making process. This involves 1. Identifying the potential issue and its scope, 2. Consulting relevant accounting standards and regulatory pronouncements, 3. Engaging with qualified actuarial professionals to review and validate assumptions and methodologies, 4. Quantifying the financial impact of any adjustments, 5. Documenting the entire process, including the rationale for all decisions made, 6. Ensuring transparent disclosure of significant judgments and assumptions in the financial statements. Question 18. Governance review demonstrates that a property insurance claim has been submitted following a reported fire incident. The policyholder has provided initial photographs of the damage and a written statement detailing the events. The policyholder is eager for a swift resolution to begin repairs. The claims handler, a certified insurance industry professional CIIP, is aware of the policy terms and the potential for fraudulent claims. What is the most appropriate course of action for the CIIP to take in managing this property insurance claim? Option A. Immediately approve the claim for the full amount requested by the policyholder, based on their statement and provided photographs, to expedite the repair process and maintain customer satisfaction. Option B. Offer a significantly reduced settlement amount based on a quick visual estimation of the damage from the photographs, without a detailed assessment or justification, to minimize the insurer's payout. Option C. Initiate a formal, documented investigation into the cause and extent of the property damage, gathering all relevant documentation, conducting a site inspection, and obtaining expert opinions if necessary, before determining the claim's validity and settlement amount. Option D. Deny the claim outright due to perceived minor inconsistencies in the policyholder's written statement, without conducting any further investigation to verify these concerns. The correct answer is A. Immediately approve the claim for the full amount requested by the policyholder, based on their statement and provided photographs, to expedite the repair process and maintain customer satisfaction. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's immediate desire for a quick resolution and the insurer's obligation to conduct a thorough and fair claims assessment. The challenge lies in balancing the need for efficient claims handling with the regulatory imperative to ensure accurate assessment, prevent fraud, and maintain policyholder trust. The CIIP professional must navigate this by adhering strictly to established claims investigation protocols, even when faced with pressure to expedite. Correct approach analysis. The correct approach involves initiating a formal, documented investigation into the cause and extent of the property damage. This aligns with the regulatory framework for property insurance claims, which mandates a fair and impartial assessment based on evidence. Specifically, it upholds the principles of good faith and fair dealing expected of insurers. By gathering all relevant documentation, conducting site inspections, and obtaining expert opinions where necessary, the insurer demonstrates its commitment to a thorough and objective evaluation, thereby fulfilling its regulatory obligations and protecting against potential misrepresentation or fraud. This methodical approach ensures that the settlement, if any, is based on factual findings and policy terms. Incorrect approaches analysis. One incorrect approach involves immediately approving the claim based solely on the policyholder's statement and photographic evidence without further investigation. This fails to meet the regulatory requirement for due diligence in claims assessment. It bypasses essential steps like verifying the cause of loss, assessing the full extent of damage, and checking for potential policy exclusions or misrepresentations, thereby exposing the insurer to financial risk and potentially violating principles of fair claims handling. Another incorrect approach is to deny the claim outright due to perceived inconsistencies in the policyholder's narrative, without conducting a comprehensive investigation to substantiate these concerns. can be seen as a failure to act in good faith. Denying a claim without a thorough, evidence-based assessment can lead to regulatory penalties and damage the insurer's reputation. It presumes fault or fraud without due process. A third incorrect approach is to offer a significantly reduced settlement amount based on an arbitrary estimation of damage, without a proper assessment or justification. This undermines the principle of fair settlement and can be construed as an attempt to unfairly benefit the insurer at the policyholder's expense. It lacks the transparency and evidence-based reasoning required by regulatory guidelines for claims resolution. Professional reasoning. When faced with a property insurance claim, a CIIP professional should adopt a structured, evidence-based decision-making process. This begins with understanding the policy terms and conditions. Next, initiate a prompt but thorough investigation, gathering all necessary documentation and evidence. This includes verifying the reported loss, assessing the damage objectively, and identifying any potential issues. Throughout the process, maintain clear and professional communication with the policyholder. Adhere strictly to regulatory requirements for claims handling, ensuring fairness, good faith, and transparency. If discrepancies arise, address them through further investigation and evidence, rather than making assumptions or offering arbitrary settlements. This systematic approach ensures compliance, protects both the insurer and the policyholder, and upholds professional integrity. Question 19. Assessment of the most appropriate method for an insurance company operating under the Certified Insurance Industry Professional (CIIP) regulatory framework to pool its underwriting risks for a newly launched specialized cyber insurance product, considering the need for regulatory compliance, financial stability, and effective risk management. Option A. Establish a dedicated reinsurance pool for the cyber insurance line, managed by a regulated third-party administrator with expertise in cyber risk and subject to regular CIIP audits. Option B. Enter into informal, verbal agreements with other insurers to share potential cyber losses on a case-by-case basis as they arise. Option C. Create a captive insurance company solely for the cyber insurance product, with minimal external oversight and no formal risk transfer agreements with other entities. Option D. Aggregate premiums from the cyber insurance product, with those from the company's general liability and property insurance lines, into a single, undifferentiated claims reserve fund. The correct answer is A. Establish a dedicated reinsurance pool for the cyber insurance line, managed by a regulated third-party administrator with expertise in cyber risk and subject to regular CIIP audits. Explanation. This scenario presents a professional challenge because it requires an insurance professional to navigate the complexities of pooling risk within a specific regulatory framework, ensuring that the chosen method aligns with both the insurer's financial stability and the regulatory mandate for fair and equitable risk distribution. The challenge lies in balancing the operational efficiency of risk pooling with the stringent requirements of the Certified Insurance Industry Professional (CIIP) jurisdiction, which prioritizes consumer protection and solvency. Careful judgment is required to select an approach that is not only financially sound, but also compliant with all applicable laws and guidelines. The correct approach involves establishing a dedicated reinsurance pool for a specific line of business, managed by a third-party administrator with a proven track record and subject to regular regulatory oversight. This approach is correct because it directly addresses the core principles of risk pooling by spreading risk across multiple entities, thereby reducing the impact of individual large losses on any single insurer. From a regulatory perspective, this method is often favored as it allows for clear segregation of risks, facilitates accurate actuarial assessment, and enables regulators to monitor the solvency and operational integrity of the pool more effectively. The involvement of a third-party administrator, when properly vetted and regulated, adds a layer of professional management and compliance, ensuring adherence to the CIIP jurisdiction's guidelines on governance and operational standards for pooled risk arrangements. This aligns with the overarching regulatory objective of maintaining a stable and trustworthy insurance market. An incorrect approach would be to simply aggregate premiums from various unrelated lines of business into a single, undifferentiated fund without specific reinsurance arrangements or dedicated management. This is professionally unacceptable because it fails to adequately segregate and manage risks associated with different insurance products. Such a practice could lead to cross-subsidization of losses between disparate lines, potentially undermining the actuarial integrity of pricing for certain products, and exposing the insurer to unforeseen liabilities if a particular line experiences a catastrophic event. This approach would likely violate CIIP regulations concerning risk management, solvency requirements, and the accurate reporting of financial exposures. Another incorrect approach would be to establish a captive insurance company solely for the purpose of internal risk retention, without any external risk transfer mechanisms or independent actuarial validation of its pooling capacity. Captive insurance is a form of risk pooling, operating it in isolation without adhering to the specific regulatory requirements for such entities within the CIIP jurisdiction, particularly concerning capital adequacy, governance, and reporting, would be a significant failure. This could be seen as an attempt to circumvent established regulatory oversight designed to protect policyholders and ensure market stability, potentially leading to undercapitalization and an inability to meet claims obligations. A third incorrect approach would be to rely on informal agreements with other insurers to share losses on an ad hoc basis, without a formal, documented pooling agreement or regulatory approval. This is professionally unsound because it lacks transparency, predictability, and regulatory oversight. Such informal arrangements are inherently unstable, difficult to manage, and do not provide the necessary assurances of financial security or compliance with the CIIP jurisdiction's requirements for risk transfer and pooling mechanisms. Regulators would view this as a failure to implement robust risk management practices and a potential threat to policyholder protection. The professional decision-making process for similar situations should involve a thorough understanding of the specific regulatory framework of the CIIP jurisdiction. Professionals must first identify the regulatory requirements for pooling risk, including any stipulations on the types of risks that can be pooled, the structure of the pooling arrangement, capital requirements, governance, and reporting obligations. They should then evaluate potential pooling strategies against these requirements, considering the insurer's risk appetite, financial capacity, and strategic objectives. Engaging with legal and actuarial experts familiar with the CIIP jurisdiction's regulations is crucial. The decision should prioritize approaches that offer clear regulatory compliance, robust risk management, financial solvency, and transparency to all stakeholders, including regulators and policyholders. Question 20. Upon reviewing a prospective client's application for a complex commercial property insurance policy, the underwriter identifies several areas where the provided information appears incomplete regarding the building's structural integrity and fire suppression systems. The underwriter needs to gather more details to accurately assess the risk. Which of the following approaches best aligns with regulatory requirements and professional ethics for information gathering in this scenario? Option A. Contacting the client directly to request specific documentation and clarification on the identified gaps in information, explaining the necessity for these details in the underwriting process. Option B. Conducting an independent, unannounced site inspection of the property to gather information without the client's explicit prior consent or knowledge to verify the existing information. Option C. Informing the client that additional, unspecified information is required and implying that failure to provide it will result in a significantly higher premium or policy denial, without clearly stating what specific information is needed. Option D. Making reasonable assumptions about the building's structural integrity and fire suppression systems based on the general characteristics of similar properties in the area, and proceeding with the underwriting based on these assumptions. The correct answer is A. Contacting the client directly to request specific documentation and clarification on the identified gaps in information, explaining the necessity for these details in the underwriting process. Explanation. This scenario presents a professional challenge because the insurance professional must balance the need for comprehensive risk assessment with the ethical and regulatory obligations to protect client confidentiality and avoid misrepresentation. The effectiveness of the risk assessment hinges on the quality and completeness of the information gathered, but the methods used to obtain this information must be lawful and ethical. Careful judgment is required to ensure that the information gathering process is both thorough and compliant. The correct approach involves a systematic and transparent process of information gathering that aligns with regulatory requirements for underwriting and client interaction. This approach prioritizes obtaining accurate and relevant information directly from the client or authorized sources, while clearly communicating the purpose of the information collection. It adheres to principles of fair dealing and avoids any actions that could be construed as deceptive or intrusive. Specifically, regulatory frameworks governing insurance underwriting emphasize the importance of obtaining accurate risk information to ensure fair pricing and appropriate coverage. Ethical guidelines also mandate honesty and transparency in all dealings with clients. An incorrect approach that involves making assumptions based on limited or external data is professionally unacceptable. This failure stems from a disregard for the regulatory requirement to base underwriting decisions on verified information. It also violates ethical principles of fairness and accuracy, as it can lead to mispricing of risk or denial of coverage based on potentially inaccurate or biased inferences. Furthermore, relying on assumptions without client consent or verification can breach data privacy regulations and erode client trust. Another incorrect approach, which involves exaggerating the need for certain information to elicit a more detailed response, is also professionally unacceptable. This constitutes a form of misrepresentation and can be seen as manipulative. Regulatory bodies strictly prohibit deceptive practices in the insurance industry, and such behavior undermines the integrity of the professional-client relationship. Ethically, it is imperative to be truthful and transparent in all communications with clients. The professional decision-making process for similar situations should involve a clear understanding of the regulatory framework governing information gathering for risk assessment. Professionals must prioritize obtaining information directly from the client through appropriate channels, such as application forms, interviews, and requests for documentation. Transparency about the purpose of information collection is paramount. When faced with incomplete information, the professional should follow established procedures for seeking clarification or additional details from the client, rather than resorting to assumptions or misleading tactics. Adherence to ethical codes of conduct, which emphasize honesty, fairness, and client welfare, should guide every step of the information gathering process.